significant tax savings and liability protection without double taxation. These are just some of the benefits that make S Corporation status so appealing to small business owners. Understanding how to properly elect S Corp status can be the difference between paying thousands more in taxes or keeping that money in your business. An S Corporation is a specific type of corporation created through an IRS tax election. It allows qualifying businesses to avoid double taxation while still protecting owners from personal liability. This popular business structure represents about 70% of all corporations in the United States. Before you can elect S Corp status, your business must meet several IRS requirements. Your corporation cannot have more than 75 shareholders, and these shareholders must be individuals, certain trusts, estates, certain partnerships, tax-exempt charity groups, or other S corporations. A married couple counts as one shareholder for this limit. Your corporation must be based in the United States with no foreign investors. You can only have one class of stock issued, meaning if you've already issued both common and preferred stock, you're not eligible. Your tax year must end on December 31st, and all shareholders must agree to the S Corp election. The filing process involves submitting IRS Form 2553, also known as election, by a small business corporation. Timing is critical. You must file this form within 2 months and 15 days after the start of your tax year for the election to be effective that year. For newly formed businesses, this means filing within 2 months and 15 days of incorporation. For existing businesses, you can file anytime during the first 2 months and 15 days of your tax year, with the election taking effect the following tax year. If you miss the deadline, you may still qualify for late election relief under IRS Revenue Procedure 2013-30, provided you can demonstrate reasonable cause for the delay. All shareholders must sign the form consenting to the election. The advantages of S Corporation status are substantial. Unlike some states that require at least 2 people to form an LLC, you only need 1 person to form an S Corporation. S Corporations have perpetual existence, unlike LLCs that often have limited lifespans. Shareholders can freely transfer their stock without requiring approval from other shareholders. This provides greater flexibility for ownership changes compared to many LLCs. One of the most significant benefits involves self-employment taxes. In a sole proprietorship or partnership, owners pay self-employment tax on all business profits. With an S Corporation, only the amount paid as reasonable salary is subject to employment taxes. The remaining profits distributed as dividends avoid these taxes, potentially saving thousands of dollars annually. S Corporations also provide pass-through taxation. Unlike regular C corporations that face double taxation, S Corp don't pay corporate income tax. Instead, profits and losses pass through to shareholders' personal tax returns. This means business losses can offset other income on shareholders' returns, reducing their overall tax burden. Electing S Corp status creates several tax planning opportunities. The split income strategy allows business owners to pay themselves a reasonable salary subject to FICA taxes while taking remaining profits as dividends, not subject to self-employment tax. Shareholders may also qualify for the Qualified Business Income Deduction under Section 199A, potentially reducing taxable income by up to 20%. When selling the business, S Corp typically face single-level taxation rather than the double taxation C corporations experience. Despite these advantages, S Corporation status does have some drawbacks. S Corp must follow corporate formalities, including filing articles of incorporation, holding director and shareholder meetings, maintaining corporate minutes, and allowing shareholder votes on major decisions. This increases administrative burden and potentially legal and tax service fees. S corporations can only issue common stock, which may limit capital raising options. They also cannot file for initial public offerings, restricting growth potential for businesses with those aspirations. State-level tax considerations vary significantly. While the IRS recognizes S corporations for federal tax purposes, states may treat them differently. For example, California imposes a 1.5% franchise tax on net income with a minimum tax of $800, regardless of profitability. Some states require separate state-level elections to recognize S corporation status, while others don't recognize the S election at all, taxing S Corp as regular corporations. Consulting with a tax advisor about your specific state's rules is essential before making the election. For businesses operating as LLCs, you can combine the benefits of both structures by electing to be taxed as an S corporation while maintaining LLC status. This approach reduces administrative work compared to forming a corporation while still receiving pass-through tax benefits. To do this, first file Form 8832 to elect corporate tax treatment, then file Form 2553 for S corporation status. This strategy is particularly beneficial once your LLC earns more than $40,000 in annual net income, as the self-employment tax savings typically outweigh the additional compliance costs. When considering this election, remember you must pay yourself a reasonable salary, which requires consistent payroll processes and compliance with employment tax rules. The election remains in effect until voluntarily revoked or terminated by the IRS due to eligibility violations. The recognition period after first filing as an S corporation lasts 10 years. During this period, selling or distributing assets may trigger built-in gains tax at the highest corporate income tax rate. This rule prevents corporations with appreciated assets from electing S status solely to avoid taxes on asset distribution. S corporation status offers substantial tax advantages and liability protection for qualifying businesses. By understanding the requirements, filing process, and planning opportunities, you can maximize these benefits while minimizing potential drawbacks. Whether you're forming a new business or considering restructuring an existing one, proper evaluation of S corporation election could significantly impact your bottom line for years to come.